Welcome to your weekly market update. My team told me I look like a news anchor doing these updates, so I ditched the suit today and went with my Jordan t-shirt in honor of being in Chicago. Thank you for all of you that came out to our client appreciation opening day party for the Cubs. My favorite thing in life is, besides my family, my faith, and my team, is the Chicago Cubs. So thank you for coming out and supporting one of my passions. We donated $1,800 to St. Jude's. We gave away some tickets to the game. So just thank you all for that came out. As far as the market, we are seeing a lot of volatility. Let me tell you why. Once again, this is why you hire me. One of my superpowers is understanding these markets and when the best time to lock in is. You can see that we did that on Friday. Remember, higher on this chart, better. So anyone closing within 30 days, we locked here. So that was about a 3/8 to a 0.5% in interest rate improvement for those people that started with me 30 days ago. You can see that was about here, and we locked here, which is about a 0.5% better in interest rate. And then we protected everyone by about a 0.25% of interest rate over the last couple of days. So this is why you work with me. Now, why is this happening? A lot of it is inflation. Obviously, mortgage rates will follow inflation long term. There's some things happening that are putting pressure on it. Ukraine bombed with some drones the third largest refinery for oil in Russia. Obviously hurts our oil prices. We're now at $85 a barrel. There was some attacks on the Iran embassy, and they say they're going to retaliate. So we have some geopolitical stuff going on that's going to put pressure on inflation. And also, the inflation numbers just aren't going to come down until either the job market gets bad, or we see prices in oil improvement or a reduction in rent. We believe that will happen in the second half of the year. We stick by our prediction that interest rates are going to be 5% by the end of this year, beginning of next. But that has been prolonged. So we need bad jobs data, which is not what we want to root for, but that's what will cause the Fed to bring down interest rates. Every time Jerome Powell talks, the Fed chairman, you hear a flip-flop between being dovish, which means cutting rates, and being hawkish, which means they're going to be more patient. Right now, he's saying they're going to be more patient unless there is some weakness in the job market. So we'll see this Friday. Friday's the Bureau of Labor and Statistics report. There's been some manipulation with those numbers, and unfortunately it's an election year, so you don't know if you can trust the data or not. It's been proven that you can't by some of the revisions and some of the adjustments that, if you follow the reports closely, are just abnormal, and they're counting second and third jobs as primary jobs. So when I say they, I mean the BLS, and that's driven by the government. So we'll see what happens. The prediction is 200,000 jobs. If we have a huge miss and it comes in at like 150, 125, or there's some revisions for the previous months, because remember, these reports are estimates, not the actual, and within about 90 days of the month, so January, you could see some revisions lower. If that happens, you'll see rates get better. If it doesn't and it comes in about 200,000 or around there, we'll stay the same. If it's a much better report than 200,000, you'll see rates go up. So that's just how it's going to work. We're on top of this all for you. Keep up on your home search. Email us if you have a property you're going to be making an offer on, and we'll get you current numbers, because as you can see, it's volatile, it's choppy. They're changing each and every day. Call us anytime with any questions.